What if I told you that more than half of Canadian homeowners renewing their mortgage in 2026 could see their monthly payments jump by hundreds, sometimes even thousands, of dollars overnight? No job loss, no lifestyle change, just a renewal letter from the bank that quietly detonates their budget. For many families, this won't feel like a slowdown, it'll feel like a financial ambush. Here's the uncomfortable truth. During the pandemic, millions locked in record-low interest rates, assuming the good times would last. Now those same mortgages are racing toward renewal in a much higher rate world. Economists are already warning about rising defaults, forced home sales, and markets cracking under pressure. And the scariest part, most people still think they're safe. In today's video, we're breaking down 10 Canadian cities where the warning signs are flashing brightest. Some are obvious, others will shock you. If you own a home, or plan to, what you're about to hear could change how you see 2026 forever. Number 1. Toronto. Toronto sits at the very center of Canada's upcoming mortgage storm, and for good reason. This city holds some of the largest mortgage balances in the entire country, meaning even small interest rate increases translate into massive monthly payment shocks. During the pandemic, buyers stretched themselves to the limit, often bidding hundreds of thousands over asking, confident that ultra-low interest rates would protect them. But those protections are expiring. By 2026, a huge portion of Toronto homeowners will be forced to renew at rates 2 to 3 times higher than what they locked in, turning once manageable payments into serious financial burdens. What makes Toronto especially vulnerable is its heavy reliance on variable-rate mortgages and investor-owned properties. Research from Canadian banks shows that investors are far more sensitive to rising costs than long-term homeowners. When payments rise faster than rents, investors don't wait, they sell. Add to that the massive condo market, where carrying costs are already high, and you have a recipe for rising listings and downward pressure on prices. Economists consistently find that markets with high investor concentration experience sharper corrections during rate shocks, and Toronto checks every one of those boxes. For everyday homeowners, the danger isn't just price declines, it's cash flow collapse. A household that could comfortably handle a $3,000 mortgage payment may suddenly face $4,500 or more at renewal. That difference doesn't come from cutting coffee or skipping vacations. It forces real decisions like refinancing, selling, or taking on more debt just to survive. Toronto isn't facing a crash because people made bad choices. It's facing stress because the system changed. And for many homeowners, that change is coming faster than they're ready for. Number 2. Vancouver. Vancouver has long been one of the most expensive housing markets in North America. But what makes it especially dangerous heading into 2026 is not just high prices, it's how those prices were financed. For years, homeowners leaned heavily on cheap credit, home equity lines, and refinancing to stay afloat in a city where incomes lag far behind housing costs. During the low-rate era, this worked. Monthly payments looked manageable, and rising home values masked the true level of financial strain. But when those mortgages renew at much higher rates, the math quickly turns against homeowners. Economic research consistently shows that markets with extreme price-to-income gaps are the most sensitive to interest rate shocks, and Vancouver sits at the top of that list. Many households are already devoting a huge portion of their income to housing, leaving very little room to absorb payment increases. Even a modest rate jump can push families from stability into stress. Unlike past cycles, homeowners can't rely on rapid price growth to bail them out. If prices stagnate or fall while payments rise, equity stops being a safety net and starts becoming a trap. The real risk in Vancouver is a wave of quiet distress, not loud collapse. Homeowners may try to hang on by draining savings, delaying retirement, or taking on secondary debt. But as renewals pile up in 2026, some will be forced to sell into a market filled with others doing the same thing. That's how pressure builds slowly, then suddenly. Vancouver doesn't need a crash to feel pain. Just a few thousand households hitting renewal at the same time is enough to shake one of Canada's most stretched housing markets. Number 3. Hamilton. Hamilton is one of the cities that's caught in a precarious position heading into 2026. Once considered an affordable alternative to Toronto, Hamilton saw an explosive surge in housing prices during the pandemic as people sought more space while still being within commuting distance of the big city. However, many of these buyers enter the market during a time of historically low interest rates, taking on large mortgages to purchase homes they could only afford under those favorable conditions. Now, as those mortgages approach renewal, homeowners are staring down the harsh reality of much higher rates and the financial strain that comes with it. The real trouble for Hamilton lies in the fact that the city experienced rapid price growth without the economic fundamentals to back it up long-term. While other cities had steady, sustainable appreciation, Hamilton's market was driven by speculative buying and investor interest, which makes it especially vulnerable to market corrections. As interest rates rise, many homeowners who bought in the last few years may find that they're now underwater, owing more on their mortgage than their home is worth. This is a real risk for a city where home values have only recently spiked and are now beginning to show signs of flattening. For homeowners in Hamilton, the scenario is even more concerning because the city has a high proportion of first-time buyers who may not have the savings or financial flexibility to handle a significant payment increase. A lot of these buyers stretch their budgets to afford properties that were once within reach but are now pushing the limits of affordability. As mortgage renewals hit in 2026, many will face payment shock, and without much equity to lean on, they'll have few options. In the worst-case scenario, this could lead to an uptick in forced sales and financial distress, which could have lasting effects on the city's housing market. Number 4. Brampton. Brampton, often seen as a bustling suburban hub just outside Toronto, is facing a storm of its own as we approach 2026. Known for its rapidly growing population and diverse community, the city saw a significant uptick in home sales during the pandemic, as people sought more affordable options compared to the sky-high prices in Toronto. However, many of these new homeowners took on larger mortgages than they could comfortably afford, buoyed by the allure of historically low interest rates. As those low rates come to an end and mortgages start to reset at higher rates, Brampton residents are set to experience one of the most severe payment shock waves in the region. What makes Brampton particularly vulnerable is its reliance on high household debt and multiple mortgage holders per household. Many buyers in Brampton, particularly immigrants and first-time buyers, enter the market with less financial flexibility, often relying on the combined income of multiple family members to make ends meet. As rates rise, those families could face a massive squeeze on their budgets. For some, the increase in monthly payments could be the tipping point, leaving them unable to afford their homes. With so many buyers purchasing homes with little room for error, even a small shift in rates can lead to major financial strain. Moreover, Brampton's real estate market has become increasingly dependent on private lending and non-traditional financing methods, which adds another layer of risk. When the market cools and values stagnate or decline, these buyers may struggle to refinance or sell without taking a significant loss. This creates the perfect conditions for a potential flood of distressed sales. As more homeowners face unaffordable payments, we could see an influx of properties hitting the market, further driving down prices. For Brampton's homeowners, the road ahead is anything but certain, and the coming mortgage renewals could be a financial reckoning that many are unprepared for. Number 5. Mississauga. Mississauga, one of Ontario's largest cities, has been on a strong growth trajectory for the past decade, with housing prices skyrocketing as more people flock to the suburbs in search of affordable alternatives to downtown Toronto. However, behind the impressive growth lies a concerning reality. Many homeowners have stretched themselves thin by taking on large mortgages during a time of record low interest rates. As those low rates are set to expire and renewals hit in 2026, many will face significant payment shocks that could quickly turn their once affordable homes into financial burdens they can't bear. What makes Mississauga particularly at risk is the prevalence of high-priced detached homes, where homeowners have taken on substantial debt in exchange for larger living spaces. With the area's property values inflating at a rapid pace, buyers may have felt confident that rising equity would protect them from financial strain. But now, as the Bank of Canada keeps interest rates elevated, those same homeowners will find their mortgage payments climbing substantially, with some likely seeing monthly increases of $1,000 or more. This sudden spike in costs could push many families into a situation where their monthly payments consume far more of their income than they anticipated, creating an increasing risk of delinquency or forced sales. The added pressure in Mississauga is that the city's economy, while growing, is not immune to global pressures and market slowdowns. While some sectors are strong, The region's heavy reliance on corporate tenants and a transient workforce means that the housing market could face volatility in the coming years. In a market where many homeowners have little financial cushion, even a slight dip in prices or job loss could leave them with few options. For Mississauga residents, 2026 could represent a pivotal moment, with a balance between rising rates and affordability could shift dramatically, triggering a wave of financial distress. If you're finding this information valuable, we'd love to hear your thoughts. Drop a comment below and let us know what you think. We put a lot of effort into these videos, so please support us by hitting subscribe. It's just one click and helps us bring you more crucial insights. Number 6. Surrey. Surrey, a rapidly growing city in British Columbia, is already seeing the early warning signs of financial strain as we approach 2026. Known for its booming population and affordable housing compared to Vancouver, Surrey attracted many first-time homebuyers and families looking for more space at a lower cost. However, like many other cities, Surrey's real estate market was built on the assumption that interest rates would stay low forever. With a large proportion of homeowners locking in fixed-rate mortgages during the pandemic, many now face the reality of significant payment increases as their renewals approach, putting them in a precarious financial position. What sets Surrey apart is its heavy reliance on new developments and suburban growth, which have made the city attractive to young families and investors. However, this rapid growth often masks deeper financial risks. Many homeowners took out large loans based on inflated home values and assumed that they could either refinance or sell at a profit if needed. But now, with rates expected to remain high through 2026, these same families may find themselves locked into mortgages they can no longer afford, as monthly payments rise sharply. Furthermore, investor activity in the market adds another layer of risk, as these buyers are often quicker to sell when the market cools or financial conditions worsen, creating additional downward pressure on home prices. Surrey's vulnerability is compounded by its relatively low income levels compared to other parts of the Lower Mainland, which means that many homeowners have fewer resources to absorb the shock of rising rates. As we approach 2026, homeowners in Surrey could face a tough choice: cut back on living expenses, take on more debt, or sell their homes at a loss. The reality is that for many in this city, the combination of higher interest rates, stagnant wages, and an over-leveraged housing market could result in widespread financial strain, with the potential for a wave of forced sales as people struggle to keep up with their mortgage payments. Number 7. Calgary. Calgary, Alberta's largest city, is experiencing a housing boom that seems poised for a sharp downturn as we approach 2026. After years of economic stagnation, Calgary's real estate market saw a resurgence, driven by a rebound in oil prices and a growing tech sector. Many buyers, encouraged by low interest rates, jumped into the market, purchasing homes with the assumption that these favorable conditions would continue indefinitely. However, as those low rates expire and renewals approach, homeowners may find themselves facing significant payment increases, making Calgary one of the most vulnerable cities for mortgage stress. The primary concern for Calgary homeowners is the boom-bust nature of the local economy, which has historically been tied to oil and gas prices. While the city's housing market has benefited from the current economic upswing, a slowdown in global energy prices or economic turbulence could quickly tip the balance. Homeowners who took on large mortgages in a more optimistic market could soon find their homes worth less than they owe, especially if property values decline in response to broader economic pressures. The combination of volatile energy prices and rising interest rates sets the stage for a potential financial squeeze that many Calgarians are unprepared for. Beyond the economic uncertainties, Calgary faces a unique challenge in that its real estate market is heavily dependent on investment and speculation, particularly in the suburban areas. With mortgage rates expected to remain high, many investors could find themselves forced to sell, leading to increased listings and downward pressure on home prices. For regular homeowners, this means a real risk of negative equity being upside down on their mortgage. As mortgage renewals hit in 2026, many Calgarians will face the difficult reality of choosing between draining savings, selling at a loss, or struggling to meet rising payments. The combination of these risks makes Calgary one of the most uncertain housing markets in Canada. Number 8. Edmonton. Edmonton, the capital city of Alberta, has seen a rise in housing demand in recent years, particularly in suburban areas, as more people sought affordable homes outside of larger cities. However, this growing market is now facing significant challenges. Many buyers in Edmonton, like in other cities, took advantage of low interest rates during the pandemic to purchase homes that they could afford only under these favorable conditions. As interest rates rise and mortgage renewals hit, homeowners are bracing for the possibility of sharp payment increases that could quickly overwhelm their finances. What sets Edmonton apart is the city's reliance on oil and gas and government-related employment, both of which can be volatile. While Edmonton has diversified its economy in recent years, it still faces economic pressures that could hurt housing demand if global oil prices fluctuate or if public sector job cuts occur. If the local economy weakens, home prices could stagnate or even drop, leaving many homeowners with mortgages larger than the value of their homes. This leaves them vulnerable, particularly as variable-rate mortgages and high household debt become more difficult to manage with the rising costs of living. In addition to these economic risks, Edmonton's housing market has seen a sharp increase in new construction in recent years, which could lead to an oversupply of properties. If interest rates remain elevated, fewer buyers will be able to afford new homes, which will put downward pressure on prices. For homeowners, this could mean a difficult decision: continue paying higher mortgage rates or sell in a market where property values are declining. As 2026 approaches, Edmonton could see a significant increase in financial distress, with many families struggling to keep up with their payments or forced to sell at a loss. Number 9. Kitchener-Waterloo. The Kitchener-Waterloo region, known for its tech sector and university presence, has been a hotbed for home buyers in recent years, drawing attention from both local and out-of-province buyers. With its proximity to Toronto and a relatively lower cost of living, many saw it as an affordable alternative for young professionals and families. However, this seemingly stable market is now facing risks as the region's housing prices have surged in recent years, leaving many homeowners stretched thin. Much like other cities, many buyers took advantage of low interest rates to secure mortgages that may now be unaffordable as rates rise. As 2026 approaches, these homeowners are facing the harsh reality of payment shocks, and the strain on household budgets could be severe. A key risk factor for Kitchener-Waterloo is its reliance on the tech industry and a relatively small economic base. While the region has seen impressive growth in tech jobs, the sector remains vulnerable to economic shifts, especially if the broader Canadian or global economy faces a downturn. If tech companies begin to cut back or relocate, there could be fewer high-paying jobs to support the rising cost of homeownership. Moreover, many homebuyers in the region are relatively new to the market, with little experience in navigating market corrections. These buyers, having paid premium prices for properties, may be unprepared for the financial strain of significantly higher mortgage payments once their fixed-rate periods expire. Finally, with rising rates, Kitchener-Waterloo's market could see an oversupply of homes. As the demand for new builds slows and current homeowners struggle with increasing payments, more properties may flood the market. This could put downward pressure on prices, forcing homeowners to either sell at a loss or face prolonged financial strain. By 2026, the combination of rising interest rates, potential job market instability, and oversupply could make Kitchener-Waterloo a market where many homeowners are left grappling with difficult choices regarding their financial future. Number 10. Montreal. Montreal, often seen as one of Canada's more affordable major cities, is starting to show signs of vulnerability as it heads toward 2026. While the city has traditionally offered relatively lower housing costs compared to Toronto or Vancouver, its real estate market has heated up significantly in recent years. Many buyers, attracted by the promise of affordability, purchased homes during a period of historically low interest rates, stretching their budgets to secure properties. Now, as those rates rise and mortgages approach renewal, homeowners in Montreal could face significant payment increases, creating a financial strain that many may not be prepared for. What makes Montreal particularly at risk is the city's popularity among first-time buyers and young professionals. These buyers often have less financial flexibility and fewer savings, making them more susceptible to the shock of higher mortgage payments. While Montreal's job market has been relatively stable, it is still vulnerable to global economic shifts and changes in industries such as aerospace, technology, and education. A slowdown in these sectors could lead to a decrease in income stability for many residents, making it harder to absorb rising housing costs. In fact, studies show that cities with a high proportion of first-time buyers and renters are particularly sensitive to interest rate hikes, as these groups have little room to weather financial hardships. On top of this, Montreal's real estate market has seen significant speculative buying, especially in certain neighborhoods. This has led to inflated home prices that may not be sustainable in the long term. If the market cools as mortgage payments rise, many homeowners could find themselves underwater, owing more than their homes are worth. As prices fall and more listings hit the market, Montreal could experience an uptick in forced sales, adding downward pressure on prices. With so many residents stretched financially, 2026 could become a pivotal year where Montreal's affordability turns into a burden for many homeowners. As we've seen today, the looming mortgage crisis in Canada is not just a distant concern. It's a reality that's quickly approaching. From Toronto to Montreal, homeowners are facing the harsh reality of rising rates and the potential for major financial strain. 2026 will be a make-or-break year for many Canadians, and understanding the risks today can help you plan for tomorrow. It's clear that the financial shock from mortgage renewals will impact millions of Canadians, and for some, it may feel like a bloodbath. Now, we want to hear from you. Which of these cities surprised you the most? Or maybe you're already living in one of these regions. How are you preparing for the changes ahead? Drop your thoughts in the comments below. Your feedback helps us improve, and we love hearing your perspective. We put a lot of effort into creating these videos because we care about your financial future. Support us by hitting that subscribe button. It's just one click, but it means the world to us. We want to keep bringing you the most important information in the most accessible way. Thanks for watching, and we'll see you in the next video.